picking up where we left off in our Tax Made Easy series and diving into how to calculate corporate tax liabilities, starting off with its first topic, accounting income reconciliation. It's a big topic, but we'll break it down so it's easy to follow and most importantly, helpful for you. If you do have questions, kindly write them down on our chat box and I will read it during the Q&A portion after the discussion. Now, it is my pleasure to introduce our speaker for today. He is a highly accomplished professional with more than a decade of experience in audit, tax, finance, and business consultancy, having worked with multinational companies and government agencies. Please welcome our co-founder and chairman, Mr. Chad Michael Bayonon. Over to you, Sir Chad.
Thanks, Jovi. Hello, good afternoon, everyone. Thank you so much for joining us with our tax webinar. We wanted to make it easy for you guys, and our topic for today is more about calculating the tax liability, accounting income reconciliation. So before we will be going with our discussion of the topic, so I guess we could try to do some recap of the discussion that we have from our last webinar. So I'll try to present the polling question for you guys so you will be able to show with me or with all of us here that you have been able to attend the last webinar that we have conducted. Okay, so we have our first polling question, right? So at least we'll be trying to do it as an interactive one. Okay, so the first polling question that we have is, I believe that you have attended our last webinar. So if ever you haven't attended the last webinar, I think you have this idea as well. So please answer on the polling question. What are the formations of the companies in the UAE? Okay. So please answer. It's only one question. Okay. All right. So we have received some of the answers already. Okay. Good. So I believe most of you guys have been attending the webinar that we have conducted, or even if you haven't attended the webinar, I believe you have an idea of what are the formations of the companies here in the UAE. So we have the free zone entities, we have the establishment, we have the limited liability companies, and we have the PJSC. And probably you might be having some questions. How about for those civil companies? Civil companies are considered establishments as well. Okay, so most of you guys have taken the or have answered the correct question, or sorry, have have the correct answer. Okay, another recap. Okay, let's have another recap question. Recap number 2. Okay, so what are the two types of taxable person in terms of UAE corporate tax? Let's have a recap. What are the two types of taxable person in the UAE corporate tax, or in terms of UAE corporate tax? Is it juridical person and magical person? Is it a natural person and a legal person? Is it a juridical person and natural person? Or is it a legal person and a magical person? Okay, so I believe we have received already some of the answers. Okay, so the answer is yes, it is actually a juridical person and natural person. Okay, there is actually 5 recaps that we have, so let's go through with third recap. Okay, so next recap, number 3. What is the value of turnover that would require the natural person to register for corporate tax? Again, what is the value of turnover that would require the natural person to register for corporate tax? So please do answer. Okay, is it 10 million? Is it 375,000? Is it 187,500 or is it 1 million? Okay, so the correct answer is not okay. The correct answer is actually 1 million. So this is a natural person. Natural person, and we are talking about corporate tax. So if it is VAT, value added tax, it would be 375,000 for mandatory and 187,500 for voluntary. But since we are talking about corporate tax, it is actually 1 million for the natural person, meaning for those establishment or any other natural person, or civil companies, that would be considered as natural person. So if they reach a threshold or a turnover or a revenue of 1 million, then they would be required to register for corporate tax. Okay, so not 10 million. 10 million is out of the picture. So the correct answer is 1 million. Okay, so let's go back to another recap. Recap number 4. Okay, so what are the exempt incomes for natural person? So this will be one of the discussions that we will be having as part of our reconciliation for a natural person. Okay, so what are the exempt incomes for natural persons? Is it wages and other employment income, personal investment income and real estate income, or real estate investment income, wages and other employment income, personal investment income? Okay, so yes, the correct answer is all of the above. That would be wages and other employment income, personal investment income, and real estate investment income. So these are exempt incomes for natural person. So again, when we are computing for the 1 million, 1 million revenue, so if ever we are computing for 1 million revenue, it will be based on the revenues that they have exempted for these three types of incomes. So if it is a real estate investment
And
income,
then I will
and we have wages and other employment as well, employment income that is excluded. And we have the personal investment income that is excluded as well in terms of computation of your turnover or your revenue. Okay, so that are considered as exempt incomes. Okay, so you guys have done it perfectly. Now another recap. Number 5. So for our recap number 5, let's talk about juridical person. So I believe you have also an idea what is the timeline required for the registration for corporate tax. So this has been one of the discussions that we have made from our last webinar. So if a juridical person was established on April 1, 2024, the issued license date is on June 15, 2024. When should be the when should the company required to register for corporate tax? Is it July 1, 2024? Is it August 2024? Or is it June 30, 2024? Or is it September 15, 2024? Okay, please do answer. So this is actually in terms of the timeline for registration. So if ever your company has been established on April 1, 2024, after the public clarifications on the timeline requirements that has been issued by the FTA to register for corporate tax. So when should you register for corporate tax? Is it July 1, 2024? Is it August 31, 2024? Or is it September or June 30, 2024? or September 15, 2024. Again, please take note of the date. It is actually on April 1, 2024 that they have been able to establish, meaning they have been able to be incorporated on April 1, 2024. So in that case, that's after March 1, 2024. So if it is after March 1, 2024, you have to register for corporate tax 3 months after your incorporation. 3 months after your incorporation. So the correct answer is July 1, 2024. Okay? So not September 15, 2024. That will be July 1, 2024. So 3 months after your incorporation, not based on your license date. That will be based on your incorporation date. For your license date, that will be if ever prior to March 1, 2024, you will be basing it based on your license if you are incorporated prior to March 1, 2024. Okay, so that's part of our recap. Hopefully you have had some knowledge for our recaps as well, that because it will be required or it will be beneficial for us whenever we are doing the calculation of our corporate tax liability. Okay, now, so what will be the topics that we will be discussing for our um, webinar for today? So since we are talking about calculating the corporate tax liability, we will be talking about taxable income. So that will be the basis or the tax base that we will be having whenever we will be doing the computation for corporate tax. Then we have the accounting income. So what's the difference between taxable income and accounting income? We will be having a discussion with it. And then we will be discussing as well, what are the exempt incomes for UAE corporate tax? And I believe from our recap earlier, we have the exempt incomes for personal investments or for natural person for personal investments, real estate investment, and then for salaries or employee-related incomes, okay, or employment-related incomes. And then we have the income reconciliation, understanding where do the adjustments came from. And then we will be having the discussion as well of a reconciliation of those adjustments that we found out, and then having an idea about the calculation of our corporate tax liability. Okay, so let's start the discussion. So normally the calculation of corporate tax liability is based on the taxable gross income, or what are the sales, the revenues that is actually within the bracket of the corporate tax or within the bracket of taxable gross income. So we will be identifying, there should be a need of identification of which are the incomes that actually part of the taxable gross income. So say, for example, if you're conducting a business, then that will be part of our taxable gross income. If ever you have an employment, that should not be part of the taxable or taxable gross income. And if ever it is personal related for a natural person, then that shouldn't be added as part of your taxable gross income. So technically, it's more into your sales of your business. And then it will be deducted with acceptable deductible expenses provided by the law. So whenever we will be having a list of expenses, then we will be identifying which of these expenses are actually acceptable or not with the tax authorities. So normally, this is how you will be doing the taxable income. You identify what is your gross income, what is included as part of the taxable gross income or your sales, and then you will be needing to deduct the acceptable deductible expenses, and then you will be able to get the taxable income. So this is generally the way or the way of calculation of your taxable income in multiple countries, in different countries. And then you'll be considering the taxable income as your tax base for computation of your tax liability. So the first 375,000 would be at 0%. And then in excess of 375,000, that will be 9%. And then we will be able to come up or to have our corporate tax liability. So this is the normal presentation for most of the countries. Okay, for most of the countries. But for UAE, they made it more simpler. They made it relatable on what has been the income you have in the books. Because here, the difficult part of this one is actually you will be having a differences with your books of accounts. So how are you going to manage those differences? Would you just be picking up which are the gross income that would be there? So for UAE, they have come up with a calculation of making it as a two-step approach or a simpler approach in terms of calculation of your corporate tax liability. So how they have been able to do it? It's just a two-step approach. So the first approach is actually determining your accounting income. So again, as what I have mentioned earlier, normally you have your own books of accounts. So from your books of accounts, whatever will be the profit that you have generated with it, from your books of accounts or what we call as financial statements, that will be the basis or the first step that you're going to establish as part of the calculation of your taxable income. And then thereafter, we will be having to apply the relevant adjustments to that certain income to arrive for our taxable income amount. So since you already have the books with you and you have there your accounting income, then we need to apply what are the adjustments related to it. So it will become easier for us and it will be determinable of which are those acceptable ones. The reason being is here, mostly for other countries, there are actually itemized deductible expenses. There are some cases that those itemized deductible expenses are not the same with the accounts that has been used by the other companies. So because of that, it might be a bit tedious for the taxable person to file for corporate tax because they need to identify, okay, instead of having the travel and allowances, they have to transfer it to transportation expenses and they have to reclassify it. So it becomes tedious. And then when you do the reconciliation, it will be a bit difficult. So to make it more simpler, okay, well, get your books. How much is your accounting income under your books? And what will be the relevant adjustments that needs to be done with the books or the information that you have provided with us as part of your accounting income. Okay, so this is the two steps in terms of determination of your taxable income. Now, before we go on with our discussion on the accounting income, let's have the trivia or question. Okay, so let's see. So which of the following is the starting point of determination of taxable income for UAE corporate tax? Okay, so um, we have a polling question placed. So which of the following is the starting point of determination of taxable income for UAE corporate tax? Is it revenue? Is it the expenses? Is it the accounting income, including the other comprehensive income? Or is it accounting income, excluding the other comprehensive income? Okay. So there might be some questions. What is other comprehensive income? Other comprehensive incomes are actually reflected as part of the incomes that will be subject for realization. So most of it will be related to um, let's say the debentures. It's just like or forwards or any other or revaluation. So that will be part of the other comprehensive income as well. So most of this other comprehensive income are actually reflected on the IFRS standards of what should be reflected as part of the OCI. Okay. So the correct answer is that would be accounting income including the other comprehensive income. So that's the starting point of determination of taxable income for UAE corporate tax. Again, showing here. So normally, this is the normal presentation of other countries as well, for most of the countries. But for UAE, they made it more simpler. They made it as a first determining point would be your accounting income, and your accounting income includes other comprehensive income. So whenever you have the audited financial statements, this is what we call as statement of comprehensive income. So you will be able to see from there your profit and loss plus your OCI. Okay, so that's the basis, or that's the starting point of your determination of your taxable income. Okay, so we have 60% who had got the correct answer. Okay, so let's go back. So again, the two steps for a process of determination of your taxable income is based on your first is actually determining your accounting income. Second is apply the relevant adjustments to the income to arrive the taxable income amount. Okay, so the new calculation or the correct calculation is we will be starting with accounting income, then plus or minus the relevant adjustments, and then we will be able to come up with our taxable income, and this would be the basis for our tax computation for corporate tax liability. Again, tax on 375,000, that would be 0%, zero value. In excess of 375,000, that will be at 9%. Okay, so question, what is accounting income? So again, accounting income is actually your income in your books of accounts. So for those companies who don't have books of accounts, you have to start having your books of accounts. The reason being is it will be needed for you, or it will be needed for you to be able to calculate your taxable income for UAE corporate tax purposes. So when you're doing the filing, you need to have your financial statements ready, and that financial statements, which is having your accounting income, will be the first determining point in terms of calculation for your corporate tax liability. So that's under the law. Now, this accounting income that we have will be having standards on how we will be doing the bookkeeping of or the recording of our transactions for our company. So when I say standards, the standards is actually based on recognition. When are you going to recognize this as part of your expenses? When are you going to recognize this as part of your sales? When are you going to recognize this as part of your assets or like your liabilities and so on and so forth? So as per the law states that there are three acceptable standards for FTA. Three acceptable standards. What are those acceptable standards? We have the IFRS, which is the main standard that is actually acceptable by the Federal Tax Authority. And you have two options. If ever you will not be able to meet the revenue recognitions, okay, or revenue thresholds. So if ever your company is having a revenue of more than 50 million, first note that you have to have is you need to have an audited financial statements. That's part of the requirements. Audited financial statements. If ever you have a revenue more than 50 million, and if ever you're a free zone, that's actually one of the requirements. Second, if ever you have a revenue of less than 50 million, but has a revenue of more than 3 million, you need to follow or you have an option, not need, an option to follow IFRS for SMEs. So if ever your revenue is more than 3 million and less than 50 million, you have an option to follow IFRS for SMEs. So what's the difference between these two? Actually, for full IFRS, you have to follow the complete standards that has been adopted. And then for IFRS for SMEs, normally they have made it more simplified. So if you wanted to make it more simplified in your books of accounts, then you do IFRS for SMEs if ever your revenue is more than 3 million and less than 50 million. But again, if ever your revenue is more than 50 million, you have the choice, you have to follow full IFRS. Okay, now there's another option for us. If ever our revenue is less than 3 million, we have an election on having the cash basis accounting. Our cash basis accounting is actually a most simpler approach in terms of recognition of your accounting income. This is the simplest one. Now, for the tax period that we have, it should be having a tax period of 12 months. When I say tax period, it's actually a coverage of the timeline of your performance or recognition from your books of accounts. So normally, the tax period is on an annual basis. That should be on a 12-month period. So it depends with you if what is the fiscal period that you have chosen when you do the registration of your corporate tax. But normally, this fiscal period is available in your memorandum of association. So you could see it from there of your fiscal period. And that certain fiscal period is relevant for you whenever you go for filing of your corporate tax, because the basis would be at the end of your month period would be 9 months. From the end of that would be the requirement for you to file for corporate tax. Okay, but normally this is for annual tax period. Okay, but if ever you are having the first tax period, normally it would be requiring you to file for the first tax return if ever your period is actually, let's say, for example, it is ending on December 31, 2024. So the requirement is actually if ever your tax period is 6 months, more than 6 months, and I mean more than 6 months and then less than 18 months, then you will be needing to, or sorry, more than 18 months, then you, if ever we will be adding the next annual period. So if ever that will be the case, then you will be needing to file for your short tax period. So say for example, your company has chosen an tax period ending December 31, 2024. And your company has been established on June or July 1, 2024. Since it is within 6 months period, then you are needed to file for corporate tax for the end of December 31, 2024. sorry, 2023. The reason being is because the law has been established and effective on June 2023, then those period that you have been able to incorporate your company, then that's the period that you are already covered for corporate tax. So since you started on June 1, so that will be your first, or June 1 or July 1, that will be your first tax period and needs to be filed uh, for this year 2024. So supposedly that will be filed on September 2024. But they have provided an extension and it will be acceptable this December 31, 2024. So you have to make sure that you have done the filing for corporate tax. Okay? And then for the natural person, if ever your license is establishment or a civil liability civil company, then it is considered as a natural person, then you will be following the Gregorian calendar. So Gregorian calendar is actually from January to December. Again, when we say Gregorian calendar, that is automatically considered from January to December. So for a natural person, regardless of their license, if ever they have reached the threshold of 1 million, and for the period with them, that would be from January to December 31, 2024. So they need to register for corporate tax if ever they have reached 1 million, and their filing period is the Gregorian calendar automatically. Okay, so that is for tax period. Now,
Start sending yes. Thank you.
now let's go back to the accounting income. We mentioned that the applicable standards is actually either full IFRS or IFRS for SMEs, or we have the option of cash basis accounting. So what is the difference of this full IFRS for SMEs, and cash basis accounting? So when I say IFRS or full IFRS and IFRS for SMEs, that is considered as accrual accounting. And the cash basis accounting is based on the movement of your cash. Whether you have received cash, that will be considered as your sales. And if ever you paid cash, that will be considered as your expenses. Now let's have a difference between the two. So example, we have an example, okay? So for example, Cotton Company LLC was incorporated on January 1, 2024, and a tax resident of UAE. It runs a cotton distribution company, and it prepares and maintains it in its accounts on cash basis accounting, and its tax period is Gregorian calendar year. Company V or company, sorry, company Cotton Company LLC has not elected for small business relief. So there's an option for you to go for a small business relief available under the corporate tax law. Okay. So these are the transactions. So they have paid and distributed payments received. The paid and distributed payments received, that is amounting to 1,900,000. They have cottons distributed for the period of around 2.5 million. And they have advance payment received for future distributions of 400,000. And then they have paid for employee of 330,000. And then employee service rendered but not yet paid for 30,000 for a while. Okay. So they have paid, they have an employee service rendered but not yet paid of 30,000, and then cotton supplies received for the period of 2 million, and then cotton supplies paid for the period of 1.5 million, and then they have a third-party marketing service billing received for the period of 100,000, and then they paid for 50,000. So let's try to dissect the difference between cash basis and accrual accounting. Okay, so when we say it is considered as a cash basis, what would be the sales amount that we will be having? Again, if it is cash basis accounting, what would be the sales basis? We have here the cash collections. If you are using cash basis accounting, it is more simplified. So the basis for you to record your revenue will be based on your cash collected. So the cash collection that we have is actually 1,900,000, and then advance payment that we have received 400,000. So here, the revenue that will be recognized under cash basis accounting would be 2.3 million. Now, question. Is it within the requirement for usage of cash basis accounting? The answer is yes. Okay. So since they have a revenue of less than 3 million, then considered as okay to use cash basis accounting. So they will be able to get the revenue here of 2.3 million. Now, how about for the expenses? What will be the expenses that they will be able to recognize? So again, since it is a cash basis accounting, so we will be recognizing what has been the payment that we have made. So they have paid for employee of 300,000. This will be considered as part of your expenses. And then, how about for employee service rendered but not yet paid? So that will be excluded. Then we have here the cotton supplies paid for the period of 1.5 million. That is included as part of the expenses. And then a third-party marketing service that has been paid for the period of 50,000. So the simpler approach, cash basis accounting, revenue is 2.3 million. And then your expenses is based also on your payments. So you have paid 330, you have paid 1.5 million, so 1,880, and you have paid 50,000, so you have 1,880,000 as part of your expenses. So that's how simple it is for cash basis accounting. Now for accrual accounting, if you're following accrual accounting, then you will be recognizing what is the actual sales. So here, the actual sales is actually on the distributed cottons for the period. So which is 2.5 million. That's the basis of your revenue. And then the actual expenses that you have incurred. So here, you have paid 330,000 and you have incurred already 30,000 but has not yet paid. So your total expenses for employee cost is 360,000. And then for your expenses, you have your cotton supplies received for the period, which is 2 million. So disregarding this 1.5, it's only a payment. So 2 million will be your expenses. And then for third-party marketing service expenses, that will be considered as 100,000. Okay. So cash basis accounting, revenue, 2.3. Accrual accounting, 2.5. Okay. So 2.5 and 2.3. Okay. As part of our cost of sales, we have 1.5 million as what was the payment that we have made for the cotton distribution, but the cotton that we have received and delivered were actually 2 million. And then the gross profit is 800,000. So for cash basis accounting, and then accrual accounting, 500,000. And then we don't have any other income. So that is null. Then for general administrative expenses, that's for your employee cost. So we have paid for 330,000 for cash basis accounting. But since we have incurred also the 30,000, so that's considered as part of your expenses for accrual accounting. And then you have your selling and marketing expenses. You paid for 50,000. So for cash basis accounting, that will be considered as your expenses. For accrual accounting, your full amount of 100,000 will be there. Okay, so the profit for the year is for cash basis accounting, that is 420,000. For accrual accounting, that is 40,000. Do we have any OCI incomes? So since we don't have, so the accounting income that we have is 420,000 for cash basis accounting, and then for accrual accounting, which is 40,000. Okay, so that's how we will be computing for accounting income with accrual accounting and cash basis accounting. Now for this accrual accounting, again, it is based on IFRS standards. So either you choose IFRS for SMEs or you choose the full IFRS. So for full IFRS, there is actually standards on recognition of your revenue, when you will be recognizing the revenue, including your expenses, and so on and so forth. So this is only a simplified version of the comparison between your cash basis accounting and your accrual basis accounting. Now let's see if you're listening to our discussion. Let's go and launch another trivia. So let's see if this statement is true or false. So an example of an exceptional circumstances and a reason to be permitted to use the cash basis accounting and could be where the taxable person expects to exceed 3 million threshold for only one tax period. Again, is it true or false? There is circumstances or exceptional circumstances where cash basis accounting is permitted if they exceed 3 million threshold for only one tax period. Is it true or false? Again, here, the requirement is you could follow the cash basis accounting if the revenue does not exceed 3 million. And if it exceeds 3 million, they would be following the accrual accounting. Either they choose IFRS for SMEs or they will be applying full IFRS. Now the answer for this one, for the trivia that we have, is true. Under exceptional circumstances. What are those exceptional circumstances? If ever it is only happening for one tax period, for 1 year, and then for the next years, it will go back to 3 million. Or it will be going back to less than 3 million. So if that will be the case, that is acceptable for the FTA. Okay? So the way to do that is actually for you to go and apply for election of the cash basis accounting, and then to request for the FTA's approval on your exceptional circumstances. Okay, so that's part of your actions to be taken if ever you're going to use cash basis accounting. Again, the answer for this one is true. Okay, so it is under exceptional circumstances. So if it is only for one tax period that you exceed 3 million, then that's absolutely fine. But it should be having an approval by the FTA. Okay, so that's for the trivia. So now we have the difference or the reconciliation of difference between cash basis and accrual accounting. Now let's go to income reconciliation. So technically, your accounting income as per UAE corporate tax calculation is your tax base. But when we try to do income reconciliation, we try to understand what are those adjustments. It's almost the same as if we are using the normal calculation of the corporate tax liability, as if we are using it. Because the basis is actually accounting income, and then we need to reconcile what are the difference between the acceptable taxable gross income and the acceptable deductible expenses to arrive with our taxable income. So whatever would be the difference, that should be reflected as part of your adjustments here. Okay? So let's start with the reconciliation of your taxable gross income. So question, taxable gross income. In accounting income, what are those that would be part of your taxable gross income? Again, in your taxable income, what are those that is part of your taxable gross income for your accounting income? So either it will be coming from your sales, it will be coming from your other income, or it will be part of your other comprehensive income. So these are the ones that is actually to be part of your taxable gross income. Now, the first adjustment that we have for your accounting income, first adjustment, if this would be, this is our basis, right, for calculation. So as what they have mentioned, you have actually the realization election. So you have here the realization election. So what would be the first adjustment? This is the first adjustment that we have, realization election. What is this realization election? This is pertaining to your other comprehensive income. So this is the first adjustment. The question for this one is whether you're going to use realization basis or you're going to use the normal basis of your comprehensive income. So meaning, are you going to record or report this one as full amount of your recognized comprehensive income? Or are you going to use only what has been realized? So here, there is actually a difference between the two of realization and unrealized one. So when we say realization, it means that it has already been converted. So again, for example, if ever we have some forward contracts, let's say, and then on that certain forward contracts that we have, or let's say an agreement, we are buying rice or cottons in the future. Because of the fluctuation of the prices of cottons, we have made an agreement to another party that I will be buying this cotton for 75 each. And if there's any excess or reduction for it, you will be the one bearing the risk. So normally, at the end of the year, they will be having a reconciliation of this differences. Say, at the end of the year, the value of the cotton has reduced to 65. So we have, instead of paying 75, we instead of paying 65, we paid 75. So we have a loss there of 10. So that will be part of your OCI. And then if ever you made it as a realization basis, then you will be considering it only if this contract that you have has already been ended and you have paid the other party, or you have received from the other party the benefit of your agreement. So say for example, the agreement that you have is 75 and the actual is 65, so you paid 65 for the other party, and then the 15 will be paid to the other party, which you have agreed to gamble with the prices. So that's what we call as forward contract. So that's normally presented as part of your OCI. So realization basis, if you already made the payment or the contract has already been ended, then that's the time you will be doing the recognition. But if ever the contract is for future, 10 of the year, 75, then 75 was agreed with you, then the price is 65 for at the end of the year, and then on next year, the prices change. Instead of 65, or in the year of the execution of your contract, instead of 65, it becomes 85. So this way you will be having an income. So if ever you did not opt for realization basis, then at the end of the year, you will be needing to report that one. But if you opt realization basis, from the time that the contract has been executed or the contract has been ended, that's the time you will be recognizing the income. So that's clear. So that's first reconciliation. First reconciliation is your realization basis. Then the next reconciliation that we will be having is actually your other income and your revenue. So what are those for other income? Here, these are considered. There is a reconciliation here for your second reconciliation. That is your exempt income. So what are the example of exempt income? First, you have your dividends. So normally, whenever you have your accounting income calculation, your dividends normally are presented as part of your other income. You have it here as part of your dividend income. So as per the UAE corporate tax, this dividend income is not part of your taxable gross income. So meaning that should be reduced as part of your accounting income. That shouldn't be included. So you have here exempt. So that will be reduced. So aside from that, you also have the participating income. So what is this participating income? Say for example, you have an income coming from the let's say another country. You have a portion of maybe a share of the profit. It's just like a dividend actually in nature, but since there is a consideration of participating income, then that also should be considered as an exempt income, meaning that should be reduced also as part of your accounting income. Okay. Next, the other adjustments that we will be having. So we're okay actually with your taxable gross income. So we will be having the realization basis, which is coming from your OCI. And then we have as well the exempt incomes that should be adjusted, which are part of your either your sales revenue if it is participating, and then either it will be coming as well as part of your other income. So that will be considered as exempted for calculation of your corporate tax liability. Now, the second one is with deductible expenses. Now, for your deductible expenses, there is actually a consideration. The consideration for your taxable expenses is correlated with your expenses here and your expenses here. So either of these two. What are those adjustments? So you have the adjustments for number 3. You have non-deductible expenses. So either adjustments for non-deductible expenses or expenses with limitation. So limitation expenses, that is actually your interest expense, which is having a limit, your entertainment expense, which is having a limit of 50%. And the other one, the other adjustment that we have, fourth adjustment, is the connected person. So we have here the connected person adjustment also. So connected person or related party. This is what we call as transfer pricing consideration. So connected person, who are those connected persons? So connected persons are the managers or owners of the company, or possible brothers or sisters of the company that is actually paid for the benefit of rendering service with the company. So say for example, the normal example is on the license, we have one owner, LLC, maybe a local, and then we have one partner, which is an expat, who is actually acting as a manager of the company. But since they are not employed directly with the company, they are the one considered as a managing director. But since they are also part of the owners of the company, they are considered as connected person. So there will be an adjustment for connected person in terms of recognizing them as part of your expenses here. So normally you have here your management fees. So for management fees, that will be adjusted with your accounting income. It will be added back, provided that you don't have the documented research of this connected person. So there should be a marketable analysis of this connected person that they have been rendering service with the company, and this is the normal salaries or market salaries or fair value of the services of this connected person. Same goes with the related party. For the related party, that is, for example, there is another company that we have been transacting with, so we will be considering the transfer pricing. So there should be supporting documents with it, an analysis of its company structure, and then the documentation related to it. Okay, so that's the fourth adjustment. And then the next adjustment that we have is with regards to special adjustment. So this is the four adjustments related to deductible expenses. The next one is the adjustment here and your taxable income, which is correlated to the special adjustments for any reliefs for specific transactions. So say, for example, transfer of business. So there might be some income related to the transfer of business. Let's say, for example, the fair value of the business is 1 million, and then the consideration that we have received is 1.5 million. So that could be considered as part of the special adjustments. Normally, it will be reflected as your accounting income. So that should not be a part of your taxable income. So it will be reduced on your accounting income as well. And then another consideration is your tax losses. So that would be considered as an adjustment here on your taxable income. So your accounting income here will be reduced by the taxable losses. Okay. So that's for the income reconciliation. I think we have limited time. So the other detailed discussion of the income reconciliation for the expenses and then for the exempt incomes, the full details of it will be discussed on the next session. Okay, so please be there on our next session for us to be able to discuss in full details of the exemptions. So these are the list actually. I'll try to give it to you. I'm not sure what is it. Let's try to remove this. Start to remove all of this things. Okay. So next, so these are actually the list of the relevant adjustments. For a while, these are a list of relevant adjustments that is actually reflected. So this one we have discussed for our unrealized gains and losses. We have discussed portion of exempt income. And then for the deductions, relief for specific transactions, transfer pricing, and tax losses, this would be part of our special webinar series. Okay, so please stay tuned. At least you already have the difference between cash basis accounting and then the reconciliation of your income. The next topic that we will be having will be related to this. Okay,